right. Welcome to Iron Financial. This is the show where we help you forge a stronger portfolio by cutting right through all the market weakness. And today we've got a really interesting one. We're putting American Express Global Business Travel, ticker GBTG, right under the microscope. Now, you'd think this would be a titan of corporate travel, right? But the market is treating it like it's about to just fall apart. So our job today is to figure this out. Is this company built of solid steel, or is it just a pile of scrap metal waiting to be hauled away? Let's get to work.
Whoa, hold on a second. Before we start throwing around words like titans, let's just address the giant elephant in the room here. GBT go out, posts a strong quarter, they beat Wall Street's expectations, and what's their reward? The stock gets absolutely hammered, all the way down to a 52-week low. I mean, this picture makes absolutely no sense. So either the entire market is blind, or it's seeing something seriously dangerous that maybe we're not. And that's the real question we've got to answer today.
Okay, let's break this contradiction down because the details here are absolutely critical. So on one side of the coin, you've got the positive headline, right? A 36% earnings beat. They reported 15 cents a share when the street was only looking for 11. That's a solid performance, no two ways about it. But then you look at the other side, and you see this brutal market reaction. A 5.6% drop on the day, landing it at a 52-week low. And listen, this is part of a staggering 44% decline from its peak. This isn't just one bad day, folks. This is a straight-up vote of no confidence from Wall Street. Our entire mission here is to figure out why. Right, so to really understand why the market's so pessimistic, we have to start by building the bull case. It's like inspecting a building. We need to analyze the steel frame of this company before we go looking for any structural weaknesses. And I'll tell you what, on paper, the bull case, it's pretty compelling. This is not the story of a company that's in some kind of distress. It's the story of a company that is executing its plan, it's growing, and it looks like it's firing on all cylinders. So let's start examining the evidence.
The very first pillar of this bull case is the confidence coming straight from management. Just listen to the language from the CFO, Karen Williams. She's talking double-digit growth. She's talking accretive M&A, which, for those of you at home, means the deals they're making are designed to boost earnings per share from day one. And then she mentions a doubled share repurchase program. This is the language of a leadership team that is on the offensive, not the defensive. They're sending a very clear message to the market, and that message is, we believe our stock is deeply undervalued, and we are putting our money where our mouth is.
And you know what? This confidence isn't just talk. It is absolutely backed by hard numbers. So the first load-bearing pillar of this bull case has to be top-line growth. A 12% increase in revenue to $2.72 billion. In this post-pandemic world, that is a significant achievement. It tells you that corporate travel is definitely back, and it also shows that GBTG is capturing a growing piece of that market. This is exactly the kind of momentum that should be rewarded by Wall Street, not punished. And this isn't just some empty revenue growth. We're talking about profitable growth. I mean, just look at this turnaround. In 2024, GBTG lost $134 million. Fast forward to 2025, and they've generated $111 million profit. That is a $250 million swing in a single year. That demonstrates some incredibly powerful operational leverage. This growth isn't just empty calories, you see. It's translating directly to the bottom line, which is the absolute hallmark of a well-run, disciplined business. Okay, now let's talk about the moat around this business, the defensibility. A 96% customer retention rate, that is the bedrock of the bull case. It points to a very, very sticky customer base. Think about it. For these huge corporations, switching their travel management provider is a complex, expensive, and incredibly disruptive process. So this high retention rate creates a predictable, defensible revenue stream that gives the company a really solid foundation to build upon for years and years to come. And the growth story doesn't even end there. Just look at the impact of their big strategic acquisition of CWT. For quarters on end, GBTG's revenue was kind of range-bound, right? Stuck between, let's say, $590 and $680 million. But then look at Q4 of 2025. Right after they closed that CWT deal, revenue just shot up to $792 million. This is a clear step change. It's a whole new level for the company's scale and its earning power. This is the growth engine that the bulls believe the market is just completely, totally ignoring. All right, that's a pretty compelling bull case, I'll give you that. A solid foundation, a powerful growth engine, a wide moat. Sounds great. But if this structure is so sound, then why is the market trying to tear it down brick by brick? It's time to stop admiring the architect's pretty rendering and start looking for the cracks in the foundation, because I absolutely guarantee you the market has found them. He's right. The market isn't emotional.
It's a cold, calculating machine that's processing every last bit of available data. And it's looking right past those pretty headline numbers and digging deep, deep into the financial statements. And what it's found are some serious structural weaknesses that put that entire bull case at risk. The big fear here is that this impressive-looking skyscraper might just be built on a foundation of sand. And here it is, the first major crack in the armor, and let me tell you, it's a big one. A 37% year-over-year collapse in free cash flow. Now, I want you to forget all the other metrics for just a second. Forget adjusted EBITDA. Free cash flow is king. It is the absolute lifeblood of a company. It's the actual cash you have left over. You know, the cash you use to pay down debt, to reward your shareholders, to actually survive a downturn. And when you see it collapse like this, that is a 5-alarm fire for investors. Let's put some hard numbers to this because it's so critical that you understand what's happening. In 2024, the company generated $165 million in free cash flow, okay? But in 2025, a year of strong growth and a supposed return to profitability, that number plummeted to just $104 million. So why? Why did this happen? Well, it's a double whammy. Cash from operations actually went down, while at the same time, capital expenditures, that's the money they spend on just maintaining and upgrading their assets, that went up. The business is actually becoming less efficient at generating cash even as it gets bigger. That is a dangerous, dangerous trend that the market has, I think, rightly punished. And here's the second major crack, and this one is what we call a sin of omission. You just had a strong quarter. You crushed the estimates. Your stock is in the gutter. Management had a golden opportunity here to signal their confidence by raising their guidance for the year ahead. And they didn't. They just held firm and repeated their old forecast. To the market, that is a glaring sign of weakness. It suggests that maybe these good times aren't going to last, and maybe the road ahead is a lot more uncertain than they're letting on. You have to remember, in the world of investing, sometimes silence is absolutely deafening. So let's put it all together, okay? The bear case is really built on 4 key pillars of weakness. First, not raising the guidance just crushed investor sentiment. Second, that impressive headline revenue growth, well, it's largely thanks to the CWT acquisition, and it's masking what looks to be pretty tepid organic growth in the core business. Third, that collapse in free cash flow is a massive red flag about the company's operational health. And finally, and this is a big one, all of this is happening while the company is saddled with $1.5 billion in debt. High debt and declining cash flow, that is a potentially fatal combination. Okay, the bear case is strong, there's no doubt about it, but this story isn't over. Management knows about these cracks. They're well aware of them, and they have a detailed plan to repair them. And they're not just talking about patching the holes. They're talking about reinforcing the entire structure. Through strategic integration, new partnerships, and a major push into technology, they are aiming to reignite that cash flow engine and, well, prove the bears wrong. These are the wild cards that could completely change the entire narrative for this stock. And their plan of attack is coming from multiple angles. This isn't just a single bet, it's a coordinated strategy. First step, they need to do the heavy lifting of integrating CWT and realizing those significant cost synergies. Second, their new alliance with SAP Concur is specifically designed to go out and capture a larger share of that very lucrative small and medium-sized business market. Third, they're leveraging AI to drive efficiency and really cut down on operating costs. And finally, that aggressive share buyback, that is a powerful, powerful signal of management's conviction in the company's future. And look, these aren't just empty promises they're throwing out there. Each one of these levers has a real, tangible goal attached to it. The CWT integration is targeting a massive $155 million in net cost savings over 3 years. The SAP Concur partnership, it's not some vague handshake agreement. They're launching a whole new product called Complete to drive new growth. The AI initiatives are aimed at a fundamental transformation of their entire cost structure. But honestly, the most powerful statement of all is the $600 million share buyback. Management is signaling in the clearest possible terms that they believe their stock is an absolute bargain at these levels. So, here we are. It's time for the verdict. We've examined the bull case, the one built on this foundation of growth and strategic execution, and we've pressure tested the bear case with all its dangerous cracks, that falling cash flow and the high debt. So the question for every single investor looking at this is simple. Is this a deeply undervalued company on sale, or is it a classic value trap waiting to spring? As you can see laid out right here, both the bulls and the bears have a really strong case to make. The bulls, they're betting on the long-term strategic vision. They see the CWT acquisition transforming the business, they see solid growth and profitability, and they see the confidence of management in that huge buyback. The bears, though, they're focused on the here and now. They see the collapsing cash flow, the huge debt load, and that tepid organic growth that suggests the core of the business is actually weaker than it looks. The future of this company is going to be determined by which of these two forces proves to be stronger.
And the good news is the market won't be in the dark for very long. There are several key catalysts coming up on the horizon that are going to provide some much-needed clarity. First, that upcoming Investor Day in March, that is a major test for management. They absolutely have to deliver a bulletproof plan. Then, we'll be watching every quarter to see them realize the remaining $100 million in CWT synergies. That's a key metric. And the success of that new Agentia product launch will be a critical indicator of their future growth. These are the specific events that are either going to validate the bull case or confirm the worst fears of the bears. So, at the end of the day, it all comes down to one question. Do you trust this management team to execute their plan? If you believe that they can actually deliver on those synergies, that they can leverage AI, and that they can drive new growth, then this could be a rare opportunity to buy a great company at a deep, deep discount. But if you think the structural flaws, the debt, the cash flow problems are just too deep to be repaired, then this is a trap that could do some serious damage to your portfolio. The evidence is all here before you. The decision? Well, that's yours. This is Iron Financial. Now go forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.